Stop the doom scrolling and listen up because this video can totally change the trajectory of your retirement. $19 a day in a Bitcoin IRA can outrun the Fed's money printer and snowball into $21 million. Strap in for a few minutes and just watch the math unfold. Imagine handing future you a time machine that freezes today's dollars in a vault where the IRS cannot reach and inflation barely leaves a fingerprint. That machine is a tax-advantaged IRA wrapped around the hardest monetary asset on Earth, while the Federal Reserve has doubled the M2 money supply in barely half of a decade. Every paycheck that you earn is sprinting on an infinite treadmill just to stand still. Retirement is no longer a matter of saving enough. It is a race to protect purchasing power before fiat dilution turns nest eggs into omelets. In an era where geopolitical chess games are shifting overnight, machine learning breakthroughs threaten to rewrite entire labor markets, and headline inflation seeps into every aisle of the grocery store, the margin for financial error has totally collapsed. Passive strategies that once sufficed now may leave portfolios hostage to policy swings, technological disruption, and the silent tax of currency debasement. Intelligent capital allocation is no longer optional. It is the cornerstone of surviving the next decade and beyond. Today, I'm going to show you why allocating one small, disciplined daily drip, roughly the price of a drive-through combo meal, into Bitcoin inside of a Swan IRA can tilt the race in your favor. I will prove that the incorruptible scarcity that is baked into Bitcoin's code, paired with the exponential tax shelter of a Roth or traditional IRA, produces a curve that ordinary index funds simply cannot match. For now, hold the thought that every sat stacked in a protected account is a fortress wall against the relentless wave of monetary expansion. In the next few minutes, I will quantify that wall, explore all of the risks, and outline an action plan that any wage earner can execute without exotic hedge fund tricks. Let us begin. And by the way, this is not financial advice. This is financial entertainment. I'm just breaking down the math, okay? Here is the engine that powers the time machine. The Internal Revenue Code offers two specialized chambers, a traditional and a Roth, designed to let capital compound without the drag of annual capital gains tax. Now, inside either chamber, every sat that you acquire earns on the full untaxed principal year after year with reinvested gains, enjoying the same protection. In the Roth variant, you prepay income tax today, and once you reach 59.5, every withdrawal emerges free of federal tax forever. In the traditional IRA variant, you defer tax now, reduce the adjusted gross income in the present, and settle with the Treasury only when you take out the distributions later. Annual contribution limits of $7,000 a year, that creates a hidden advantage, which is behavioral discipline. $7,000 per calendar year, $8,000 once you reach age 50. That seems modest in isolation, yet it enforces consistent dollar cost averaging. The rhythm of automatic buys converts volatility from a source of fear into a source of discounted accumulation. Now, security and transparency matter because this account is the vault for all of your future purchasing power. A purpose-built Bitcoin IRA custodian does three different things: holds coins in a segregated cold storage, keeps the fees very explicit, and reports every penny to the IRS so your compliance file is bulletproof. So if you layer all of these mechanics together, you gain three different structural edges: tax-free or tax-deferred compounding, enforced accumulation through contribution caps, and institutional-grade custody without opaque pricing. These edges form the scaffolding that lets Bitcoin's asymmetric upside reshape an entire retirement timeline. I will next translate those mechanics into concrete numbers so you can see how quickly disciplined contributions build a fortress against inflation. Let's convert those mechanics into raw numbers. On this chart, every line begins with the exact same fuel, $7,000 added each calendar year, the statutory IRA maximum. I am modeling it as a smooth daily drip to mirror an automated dollar cost average schedule, and I am compounding continuously to keep the math clean. So this is based on $19 a day. If you invest $19 a day, you are maxing at $7,000 a year. The baseline right here is the S&P 500 earning its long-run 10% annual return. After 20 years of perfect uninterrupted growth, the account stands at $447,000, respectable but hardly life-altering, especially after you account for inflation. Then we can look at Bitcoin at a 20% return, which would be my ultimate bear case. So if you shift that same contribution stream into an asset that is compounding at 20%, the balance more than quadruples up to $1.9 million. That is over a 4-to-1 improvement over the stock benchmark without risking a single extra taxable dollar. And then it really starts to get fun when you look at the 25 to 35% potential CAGR. History has shown that Bitcoin cycles through CAGRs that are much higher than this. But even a middle-of-the-road 25 delivers over $4 million, which is over 9x what the S&P 500 will deliver over 20 years. If you push it to 35%, which is still greatly under the annualized performance across Bitcoin's full history, the account pierces $21.9 million, which is nearly 50 times the traditional market return of the S&P 500. But notice two key truths here. First, every single scenario begins with identical cash outlays. Second, the exponential gap widens non-linearly. That means additional upside does not just add wealth, it multiplies it at an accelerating rate. Here, the tax shelter acts like a turbocharger. No capital gain siphon, no dividend haircut, pure reinvestment of unrealized appreciation. These figures exclude the fees to keep the comparison apples to apples, yet even after accounting for a 1% trade cost and a 0.25% annual custody drag, Bitcoin curves totally dominate. So the lesson is very simple. When an exponentially scarce asset compounds inside an exponentially efficient wrapper, ordinary contributions achieve extraordinary velocity. Let this snapshot sink in because we all know that you can invest for a lot longer than 20 years. This is the difference between hoping to retire and redefining what retirement means. And this is a graph that I made assuming that you are contributing $19 per day into various investments, the 10% S&P CAGR versus the 20 to 35% Bitcoin, and this is the difference. You can see the compounding really start to work for you after year 10. Not financial advice, but this is my humble opinion. I think the most realistic number is this 30% CAGR over the next 20 years. 30 to 25% probably, so somewhere between $4 to $9 million would be the most realistic in my humble opinion. I think the average CAGR of the next 20 years will be greater than 20. That will probably be Bitcoin's terminal CAGR, according to Michael Saylor. In fact, that's his opinion. That is obviously after the outsized growth that Bitcoin will have over the next decade or so, so I do not believe that there will be an average of 20% over the next 2 decades. I think that is the extreme bear case. But that graph showed you that time is the great amplifier when it comes to investing. If we extend the horizon from 20 years to 30, the modest equity path compounds to about $1.3 million. Longer time horizons amplify the CAGR drop dramatically. Even a modest 20% Bitcoin CAGR delivers 45 times the S&P 500 result over 40 years, which really demonstrates the exponential power of sustained high growth. A fun little tidbit for you: at a 30% Bitcoin CAGR over 30 years, which in my opinion starts to be a bit of a bullish bet, but still the math says your portfolio could reach $188.2 million after investing $19 a day. So this really demonstrates how the exponential mathematics of Bitcoin compounding on top of very modest annual contributions forms generational wealth. If you stretch the lens to 40 years, the gap just becomes totally surreal. The S&P lands near $3 million. Bitcoin at 20% climbs to $140 million. 25% starts to push toward $500 million. These figures underscore an often missed truth that exponential growth is a function of time in the exponent. Each additional decade multiplies the effect. It does not merely add to it. And a lot of people listening might say, hey Adam, a 30% CAGR is totally ridiculous. Okay, even if you think that, cut it in half. Are you still happy with tens upon tens of millions of dollars versus what you could have in the S&P? The point is, even if you are ridiculously bearish and conservative on Bitcoin's price appreciation, it is still by far the better trade. It's just math. Sorry, not gonna apologize for mathematical reality. An asset that compounds at double or triple the equity rate inside of a tax shelter buys far more than luxury. It buys resilience against the unknown of the future. Keep in mind that volatility scales with return, and the discipline to stay the course becomes harder as the numbers grow larger, of course. Yet, the mathematics on this slide demonstrate that the opportunity cost of avoiding high growth exposure in an IRA is measured in orders of magnitude, not percentage points. The difference between $3 million and $140 million or more is the difference between protecting purchasing power and transforming your family legacy. My next step is to balance that potential against the practical risks of custody, regulation, and behavioral fatigue. Opportunity without rigor is simply a coin flip, so before we celebrate those exponential curves, we must interrogate the fault lines. Number one, volatility first. Bitcoin's historical drawdowns, we all know, have exceeded 70%, and the asset can traverse a full market cycle in a single calendar year. So what does that mean? It means that your emotional bandwidth must match that turbulence, because selling into panic forfeits the compounding that I just modeled for you. If you don't have the conviction in Bitcoin like I do, you can treat Bitcoin as a growth sleeve and not your entire wardrobe. Decide a percentage of total retirement capital, be it 5, 10, 20%, based on your own time horizon, risk tolerance, and your existing income streams. Inside the IRA wrapper, remember that losses are not deductible, so position sizing is your primary risk governor. Obviously, look into the custody security that is helping Swan offer this product. You always have to look at the fees with these things. Of course, Swan offers a trade fee below 1% and a 0.02% of assets per month with a $20 floor. Anything materially higher obviously helps to erode the compounding edge that you came here to capture. There's also regulatory compliance with a Swan Bitcoin IRA, which makes sense because we got to abide by the law. There's obviously regulatory compliance that Swan has to go through when they're going to offer this type of product. Everything's taken care of for you, so you shouldn't have a surprise from the IRS. Now, not everybody can handle Bitcoin's volatility. We all know that, so think of some diversification strategies if you're one of those people. Clearly, the math on the previous slides has demonstrated that a small percentage allocation to Bitcoin can have outsized returns. So if you think Bitcoin's asymmetric upside is compelling, but you're still not getting over that it is risky, well, you could continue to own the low correlation assets, treasuries, broad equities, cash reserves that could create a ballast when crypto volatility spikes. You could think of Bitcoin as the rocket stage. The other assets are the heat shield. So you can evaluate all of these vectors very candidly. Obviously, do your own research. You can document your own thresholds, your own risk, and then you can automate the plan so discipline trumps impulse. Now, remember, this is not financial advice. This is financial entertainment. But if you wanted to take advantage of a Swan Bitcoin IRA, this could be your action plan. First, you have to decide which chamber of the tax code suits your future. A Roth requires the tax payment today, but grants tax-free sovereignty on every single SAT that you withdraw after 59.5. A traditional IRA defers your taxes, lowers your current taxable income, and shifts the liability to retirement age when your bracket may be lower. Second would be to open a Bitcoin-only IRA with transparent fees and audit-grade custody. And then third, you can automate the contribution rhythm. Set a weekly or daily buy that equals the annual limit, $7,000 if you are under $50, $8,000 if you have entered the catch-up phase after age 50. Dollar cost averaging removes the emotion about buying the highs or the lows. It captures the volatility and ensures full utilization of the tax shield. Fourth would be to schedule an annual balance review, or a bi-monthly or a bi-weekly if you want. The option is totally up to you. If Bitcoin's performance somehow inflates its share of your retirement portfolio beyond your comfort threshold, you can rebalance thoughtfully. And then fifth would just be to let time work and maintain vigilance. Get your conviction in Bitcoin. Watch Swan videos every day. Listen to me talk about how it is the future monetary base. Listen to the words of the orange gospel of Bitcoin and have faith in what your investment is. So just respect the exponent. Time compounds every single one of your disciplined decisions, yet impatience can reverse years of progress in a single ill-timed trade. Commit, monitor, adapt, then let the mathematics harvest return on your hard discipline. In an age of rampant inflation and monetary expansion, technological upheaval, and all of this political flux, this systematic approach transforms uncertainty into an asymmetric edge for your retirement. The Swan Bitcoin IRA is a fantastic product for those who believe in the future of Bitcoin and for those who want favorable tax treatment. Check the link in the description below if you are interested. Have a terrific day. Do not party too hard. Class dismissed.